Thank you, Peter. And Bob and I are delighted to be able to join the conference once more to talk about our work on e-liability. As a refresher, last year when we presented the e-liability paper, it had only just been published in the Harvard Business Review, and we didn't have what is now called the E-Liability Institute, let alone even a single pilot of the e-liability method. It was just a concept that existed in a published paper. We want to, over the course of the time we have with you today, speak to some of the updates since we connected last year. The first and most important of these is the creation of the not-for-profit E-Liability Institute. The institute that is supported through generous philanthropy has been created to help companies, governments, not-for-profits, and eventually regulators consider how they might implement the e-liability principles, first in the context of individual organizations, but then as part of carbon accounting regulation more broadly across the world. One of the key updates and activities of the Institute has therefore been to run pilots. We're delighted to say that there are about a dozen pilots in various stages of completion, and about 50 further conversations with large organizations that are interested in piloting the e-liability approach, including entire governments that would like to think about using e-liability principles for their own purchasing and product design and operational decisions. We will speak to some of these pilot conversations later in this session, in part by describing the results of what was the first e-liability conference that Bob and I, together with our research collaborators, including Mark Roston, Alicia Seeger, and Tom Heller from Stanford's Door School, ran in London at the end of June this year. And that conference was, of course, entirely possible because of the incredible staff at the E-Liability Institute, our CEO, Mike Mahoney, who we would encourage you to contact if you're interested in a pilot, along with the complement of research staff that have been helping us drive these pilots into implementation. So with that brief introduction and update, we will direct you to one of our companion papers that is also presented in this conference, which is the Accounting for E-Assets. And of course, we would direct you to the original e-liability paper, which Bob will briefly summarize now. Bob, over to you.
Sure. Thank you, Karthik. So the goal when Karthik and I began our collaboration about 2.5 years ago was how to really implement the Scope 3 standard in the greenhouse gas protocol. And we haven't done the whole picture yet, but we've made progress. And the focus of our work, we can think about it twofold. One is that we're just looking at the company's supply chain emissions, what's called cradle to gate emissions. And what we saw there was the opportunity to use fundamental accounting concepts to actually measure accurately and in a way that's auditable all the emissions in a company's supply chain. But to do that, we had to make one other change, that the way that many companies are now attempting to measure their supply chain emissions is from the top down. They start from their organization, then they try to get information through all of their suppliers. If you think about any big company like an automobile company or an aircraft company, you realize that this is an impossible task because they may have 10 to 15,000 tier one suppliers, and each of those tier one suppliers could have hundreds or thousands of suppliers of their own, and it just gets to be an impossible task. And so the innovation of the e-liability method is to look in the other direction from the bottom up. Build it up from the original supply, whether it's extracting raw materials out of the ground or growing crops on a farm, and then move that information down the supply chain. And we do that by not having the company be the unit of analysis, but the output products be the unit of analysis. So the basic algorithm in the E-liability method is to take information from all your immediate suppliers, your tier one suppliers, and assume that they've gone through this process. And so every time you purchase a product or a service, you not only get physical possession of it, but you also get a report about the accumulated scope one emissions that have been incurred all the way up the supply chain to date. The organization then takes its own scope one emissions that it's using in its own operations, and in a process essentially identical to activity-based costing, will take your input purchased emissions, your generated emissions, and assigns it to all of your output products or services. And so now your output products also will have the carbon emissions that have been generated up to the stage where you now transmit that, distribute it to your immediate customers. And now they get that report with the products, and that's their inputs. They add their scope one, assign it to their outputs, and it just keeps moving up the chain. So you can think about this just straightforward inventory accounting. It's very similar to a value-added tax, where at each stage you're adding, your emissions instead of dollars to the process. And it turns out if you do this, the process works just about autonomously because it's just aggregating from stage to stage. The beauty of this system is that the emissions are recorded, measured only once at the point where the emissions occur anywhere in the supply chain. And it's not just once, it's only once. That's the only place where it has to be counted. And second, if it's audited at that point, and so if you have auditors going at each entity and assuring that these data are real and valid, and then have that audited data come up the supply chain as well through something like blockchain or tokenization, which we're beginning to explore, as we'll talk at the end of this session, with technology companies, then any company can look back up its supply chain and not only see where the emissions came from, but to see the degree of assurance that's associated with it. And again, so it means the emissions are audited once and only once where they occur. So that's a very nice feature. And now the second part, so we said that there's two things we had to do to be, in a way, implement the scope 3 is we're focusing only on the supply chain emissions and your own company scope 1 emissions. And we're not going further downstream to your customers. Several reasons for this. First, companies have very little control over what their customers do with their products and services. If you think about a mining company trying to figure out how much of their product is in an automobile or a jet aircraft and what the emissions associated with that is clearly an impossible task. And the second is that the emissions haven't occurred yet. And accounting, we look at actual realized transactions that have occurred. That makes them measurable, objective, and auditable. And when we start to talk about the future, we're in a different realm. We're in a disclosure realm where we talk about what the future might be, but we don't have the same objectivity and measurability that we have. Now, we will come up with helpful guidelines for how to think about the downstream emissions. That'll be the subject of another paper and maybe our talk at this conference next year. But for now, we're just focused on the supply chain emissions and how they move up and give companies that carbon footprint. And this is not just an accounting or a reporting exercise. I mean, our goal on this is to help companies decarbonize their supply chains. And the only way they can decarbonize their supply chains is to get accurate, objective data that they can contract with their suppliers on, but also change their decisions about which components go in a product and where do they purchase those components, how do they source them, and how do they transport them, from suppliers down the supply chain. And so this idea is to get continuous information. So this is not like an EPD or a life cycle accounting calculation, which you do, takes you 6 months to do and get approved, and then you don't change it for 3 years or 5 years. No, this is real-time information flowing down the supply chain. So that's the basic idea. And when Karthik and I had an opportunity to talk with senior people at a major regulatory agency and explain this, they seemed intrigued by it. They said, well, okay, this is accounting, and eventually we can get to audit this data in the same quality and standard as we do with financial data. So they said, so who's doing this? And there was a silence, and then one or both of us kind of gulped and said, well, nobody's doing this. It's just something we thought of as we read about, the importance of measuring supply chain emissions, that this was a feasible way to do it. And the regulator says, well, Bob, Karthik, we can't really issue a standard to do something that no company has ever tried. And we said, well, you're absolutely right. And it's incumbent upon us, the originators of this idea, to put the idea and test it in practice and show that it's feasible, it's cost efficient, that it yields accurate data, and most importantly, actionable data. Data that the companies can act upon in order to decarbonize their supply chains. And so that's been our mission for the last year since we last spoke to you at this event. And Karthik will now start to bring you up to date on some of the outputs from that effort.
Thank you, Bob. And so in a nutshell, basically, when we're thinking about e-liability, we want you to think about the following 4 core accounting properties: that the information is accurate, it's auditable, it is comparable across entities, and it's continuous. So accurate, auditable, comparable, and continuous. And that's what basically defines accounting. And that's what makes accounting not just a tool for external reporting, but as Bob said earlier, a tool for driving strategy inside the organization, a tool in this case for decarbonizing your purchasing, your product design, and your own internal operations. And we've been very fortunate that we've had some of the world's most innovative companies engage with us on this idea. Later on in this session, we'll talk about one of the world's largest tire companies and their pilot. We'll talk about one of the world's largest cement companies and their pilot. But joining us now is Piyush, who is representing Tata Steel, which is one of the world's most innovative steel companies. And Tata Steel is part of the Tata Group, which is known for many things, including being the largest manufacturing sector employer here in the United Kingdom, but also for being an organization that has now for 150 years taken a very long view on its role as a business in society. And we were delighted when Tata Steel became the first organization from that part of the world to decide, from the South Asian continent and from Asia more broadly outside of GT tires, to decide that it wants to sort of try out this method. So Piyush, thank you so much for joining us. And in a nutshell, why don't you first describe to the listeners what the pilot looked like in the context of the plant in which you actually tried it out.
Sure. Thank you, Karthik, and thank you for having me. I'll just add to what you said. So the Tata Group is also and something that we are very proud of, is held 2/3 by charitable foundations. And I think that is something that's been there for the last 100 years. But coming to the pilot, so as you said, the pilot was in Tata Steel, which is one of the top 10 steel companies in the world. We've got operations here in India, in the UK, and in Netherlands. And the current pilot that we're talking about is at one of our sites in India. This place is called Mera Mandli. It's in the eastern part of the country. I think it was an interesting site to pick up for our pilot, because in the site itself, and I think I'll probably talk about it a little later, we got 2 different methods of making steel used within the same site. So we make steel using what you typically call the blast furnace route, and we make steel using what you call as a DRI route, both within the same operations. And the e-liability accounting methodology gave us a unique way of looking at what would be the emission content of same steel with same physical properties, same chemical properties, but produced through different routes within the same plant. Is there a difference? And if there is a difference, then how do we look about it?
Thank you, Piyush. So briefly help us understand these two routes. What are the processes involved and how might they actually be different, the BOF route and the DRI route?
Sure. So let me take a step back first and just talk a little bit about how steel is made. Steel is made using two routes. One is what you'll call as primary steel making, which uses virgin iron ore, and then you reduce it to produce steel. And the second route is using scrap, which sort of comes out of let's say previously used steel, which you melt again and then produce new or fresh steel. Steel in that sense is very suitable for recycling because it's got magnetic properties, so very easy to or relatively easy to segregate, but also retains a lot of its properties when you recycle. However, if you look at the demand for steel from now till 2050 globally, you do not have enough scrap in the world to address that demand. So IEA forecasts that roughly 40 to 50% of the steel requirement of the world will come through virgin route till 2050, and only the remaining sort of 50 to 60% can come through scrap. So both routes play a role. Now, that is one sort of view to look at it. The other view to look at it is various processes in which you can use steel. So as I said, one way is a blast furnace that's been traditionally used. Largest capacity, about 70% of global capacity is blast furnace. It's very efficient. Why is it efficient? Because it takes iron ore and coal in a blast furnace, and coal is used both to reduce the iron ore into iron, so take the oxygen away, but also to melt it into liquid form, which you can subsequently process to make steel and then subsequently steel products. Right, so it's very efficient, cost effective. That's the reason why it's been the dominant route for the last 100 years or so. There's a second way of producing steel using iron ore, which is called DRI, or direct reduced iron, where you take coal, or you can use natural gas and potentially hydrogen, green hydrogen, which are less carbon intense, to reduce that iron ore into solid form iron, and then subsequently you'll have to melt it in an electric melter or an electric furnace. And the third route, which uses scrap, is you take that scrap and put it into an electric furnace, melt it, and then produce steel. And they are not exclusive in any way. So, for example, if you produce steel using scrap, and if you want to produce high grade steel, which would go into automotive outer body, for example, the purity achievable by using only scrap is not adequate. The strength is not adequate, and therefore you need to add certain amount of DRI or virgin ore based steel. Similarly, if you are operating a blast furnace, because it produces a lot of heat, it is more efficient to add a lot of scrap to it to absorb that heat, makes the process efficient, reduces emission intensity, and is sort of more circular economy friendly. So there are lots of interlinkages where both scrap and ore can be used effectively in all the three processes. Even DRI would typically go into an electric arc furnace. So it's a sort of a many to many matrix, and that needs to be kept in mind when you are trying to address how to produce steel, because you need to produce steel using ore, you need to produce steel using scrap, and both of them will mix together in the same operation. And what is the optimum way of making steel and what's the right way for each geography, as long as or unless you can measure it accurately, and that's where again e-liability accounting would come in, you miss the opportunity for optimizing the pathway for decarbonization for each of the respective geographies.
Thank you, Piyush. That's a really helpful understanding of what are the various options available to you. And basically what you've described is a setting that has multiple shared inputs, multiple outputs, and several processes which might use sort of common ingredients or common capital equipment across the production of these outputs. So what you've effectively described is a perfect setting for applying something like a cost accounting platform, but in the context of our interest here, an e-liability platform. So can you walk us through how you thought about the allocations in that context? So for instance, when you were looking at the choice between BOF and DRI, effectively, my understanding is that the virgin ore that you were using across these two had the same emissions profiles. They weren't different emissions profiles across those virgin ores. So what was distinctive in terms of the shared emissions that were being allocated across these two options?
Sure. So again, just a brief description of our plant at Miramandli. So we said we use two routes. We produce steel using the blast furnace, and you produce DRI or iron using the blast furnace, and then you produce DRI using our DRI plant. And then blast furnace goes into another process which is called basic oxygen furnace. And the output from blast furnace as well as DRI plant goes into another furnace which is called Kona, which is sort of an electric arc furnace. So what we wanted to do is we wanted to track the emission which is being either acquired or generated at each step, and then allocate to the tonnage that's going to the next process or next processes, and therefore at the end of these two routes be able to identify what is the emission intensity in the product or crude steel product that we produce. You're right that iron ore, the same iron ore sort of groups would be used across both the processes, but the energy source, the type of coal that you would use are different. While in your blast furnace route you use coking coal, which then gets processed into coke through a coke oven where some of the emission will come through, and then it goes into a blast furnace. In a DRI plant, you can take your typical DRI coal without processing it further and then put it in your plant. So different units, some common elements or some common raw material, some different raw material. And what we did was steel industry sort of globally 8% emission. So we have been reporting emission for a while, for several years. And so as an industry under the World Steel Association, we have developed a lot of methodologies to assess emission intensities of individual units of our steel making process, because then we want to benchmark against what's best in the world and whether we can achieve it. So we therefore leverage some of the existing calculation methodologies to estimate and calculate emission at each of these points. So we went to our raw material suppliers, and now some of it was owned by us, which was relatively easy to obtain. Some we had to get from large mining companies, which was sort of also relatively easy to obtain, but then some of them would come from relatively smaller based out of India mining companies who are less mature in their ability to deliver these numbers in terms of what is the emission intensity of their product. So in those cases we had to work with some sort of an average number for the industry, which again the industry over the years we have been able to estimate. The second thing that we've done is that in a steel plant there are sort of, for example, when you use coal, you have processes to assess the carbon content of the coal, and then we would get that data. We would use that data to therefore calculate the CO2 produced as part of the process. And within the steel industry, we already include some of the principles of e-liability accounting, not on a complete basis. That is, not all emissions are allocated to all the products, but some emissions do get allocated to the next sort of set of processes. And all we had to do was to build on it to make sure that we completely capture all emission of that process and allocate to all products on a particular basis based on the chemistry, and then subsequently they would go into the subsequent processes. So that's the approach that we used, at the end of which we found we found two things, to be honest. For example, we found that we've got two coke ovens, and one coke oven's coke that came out had more carbon content than the second coke oven. And then the challenge that the management would take now as to why is that the case. Yes, we got certain capex that we need to put in the second coke oven to make sure its emission intensity is as good as the first coke oven. So again, a very live case of where we have identified action that could be taken based on this study that we are able to take now. So that's one. And on the overall process route, we also have identified that one product, which is the blast furnace based product, has less emission intensity than the DRI product. Again, gives us an opportunity to look at it internally, subsequent expansions that we might want to do, which is the more appropriate way to do it. Probably DRI is less attractive than blast furnace. If you have to use ore and if you have to use coal, maybe go blast furnace. And then also at this point of time in our plant, once you produce steel using both the routes, they get mixed together, and then you do not make a distinction. Though technically it is possible because they use different lines. So is it worth now us trying to stamp a slab coming out of the Connaught route and a slab, or a DRI route, and a slab coming out of our blast furnace route? And is there therefore appetite at our customers' end to sort of buy different types of steel at a different value? So these are some of the conversations that hopefully would happen as we go along.
Excellent. That is such a powerful summary, Piyush. And just sort of to put some elements to it, so other organizations that are listening to this might be inspired by what you guys have done. First, you drew on what was already existing knowledge. So you weren't starting from scratch. As you pointed out, the steel industry already has great benchmarking out there, and that benchmarking can serve as a first pass for the kind of information you'd need, so that this makes it a less intimidating exercise. You also noted effectively that the process of allocating shared emissions to individual products was already there, although it wasn't a full allocation. So starting to think about what are the core or critical elements of emissions in this process that aren't being allocated, because as we allocate them, we might learn new things. And third, as you start allocating them, you start getting new insights. So you say, okay, why is it that, this route A is producing higher emissions than route B? Well, looks like we need to think about some new CapEx investment in route A if we want route A to be just as emissions intensive. And the final really sort of compelling element that comes out of this is now you've taken what is effectively a commodity product. Some would argue this is a product that, people would say, oh, well, you can't really differentiate different types of steel regardless of the emissions intensity because the core structural properties are the same. And you said, no, actually, we can have a conversation with customers about what is the emissions intensity in the steel that they want to buy, that they're willing to tolerate. Just like you can have a conversation with customers about cost and quality, now emissions can be a third dimension that you can verifiably introduce into that conversation. So 4 fantastic insights into this. Can you speak, Piyush, to some of the implementation challenges perhaps associated with this? Having now run this pilot, what advice might you have for organizations that are thinking about doing this? What might you do differently?
Sure. So I think I'll highlight 2 in particular. One I already sort of talked about a bit, which is being able to get information from your suppliers. Now, steel industry in some ways is closer, or so earlier in the value chain. So our largest suppliers are mining companies, which is where you would sort of will be at a very early stage of your value chain. So it's easier to get data, and I can imagine that the sort of further down the value chain a company is, the ability, because your immediate supplier will need to make sure that their step down supplier captures adequate data and pass it on. That will become more of a challenge. In our pilot also, sort of we limited our boundary on an 80-20 principle to what would be the suppliers who are sort of starting with mining or doing primary operations. So that was one of the learnings, that ability to get data at this point of time we should not underestimate. That's one. And second, and something interesting that we did not anticipate when we started the pilot, was the way we measure our carbon is slightly different to the way we measure our costs. So when raw material comes in, you at all points of time, based on the inventory that you hold and what you purchase, you are able to track and allocate the dollar figure, right? Whereas in our carbon accounting, when they come in, they all sort of, then they are blended. So you wouldn't put one type of coal into your furnace and second type of coal or second type of iron ore. You blend them together to get the most optimum blend, and then you charge them. So then that one-to-one correspondence between ore A from mine A and coal B from mine B gets lost, and we don't track it, because after that you take samples of those blends and then you use them for assessing your carbon content. So that has not been necessary till now. But if you really want to use actual data at mine level and be able to assess the emission and therefore make decisions, then a way has to be found using IT systems to sort of get beyond this breakage of the chain. And that was one of the learnings that we found, which we don't have a solution for, but something that we'll need to solve as we go forward.
Excellent. And we will pick up on that second point in some of the emerging IT that is being developed promisingly by infrastructure providers. So that is absolutely critical to make it work. But as you notice that, and as you mentioned, as you start thinking about this from a full allocation perspective, analogous to a full costing perspective, then that problem starts becoming salient. And then you start saying, okay, how do we track these things as they move through the ecosystem? One of the powerful sort of takeaways from the idea of thinking about full allocations is that some of the implications of, for instance, what you do in steel then goes on to feed positively in other industries. For instance, one of our pilots, and Bob, maybe this is a chance to bring in the conversations we've had with the cement industry and the pilot that you've done in that space. But one of our other pilots in the cement industry thinks about, in the manufacture of cement, one of the largest sources of emissions is the process through which limestone is converted into clinker. 70% of all emissions associated in cement is just that one chemical reaction. And one way in which you make effectively low emission cement is by using things like slag and fly ash as a filler, what's called a cementitious substitute, which will then retain some of the same structural properties of the eventual end-use concrete. But as you start using that slag and fly ash, you start wondering, well, where does that slag and fly ash come from? Well, it turns out that it's a byproduct in the steel making process. And one of the challenges that the cement industry is facing is that as European regulations are pushing steel companies away from using sort of blast furnace type technology, which produces slag as a byproduct, towards using electric arc technology where there won't be that kind of slag, then this kind of low emissions input into the cement making process disappears from the market. And ironically, cement becomes dirtier. So unless we have sort of this articulation of accounting across the economy, just like we do in the cost system, and then we're able to make efficient resource allocation at the level of entire sectors, companies, industries, and economies, we won't be able to make the right kind of decisions in the carbon space. So governments simply taking decisions like saying, well, we need green hydrogen steel, or we need turquoise steel, or we need, those kinds of top-down policies don't necessarily fully account for the spillover effects into other industries, which this kind of insight produces. Bob, is there something you want to add to that from the context of the urban mining case study that you've just completed for Harvard University?
This is a new case, and for the academics in the audience, this is on the system. It's something you can order and teach, and certainly we intend to teach it in our required first-year MBA course in accounting. And the idea, Harvard University, like most institutions, is trying to get to net zero. They had an additional requirement. They actually don't like fossil fuel coming in. And so they were not happy getting lower carbon cement, which is using slag or fly ash as a clinker substitute in the production of cement. So they found this new company in Connecticut called Urban Mining. It's called Urban Mining because they mine municipal waste for consumer glass that's been discarded, and in a patented process, they're able to acquire this consumer waste glass and bake off all the impurities, the labels, the ketchup, and the food particles, get it to clean, grind it up into a fine powder. And this fine powder is actually also a cement substitute. And first of all, there's a very large supply of glass sitting in these urban mine dumps, and so you can get it. And all the carbon that was used to produce the glass in the original production process has been assigned to the glass itself. And so like with recycled steel, they are starting with a zero carbon footprint. And the process of making this very fine glass powder has 5% of the carbon emissions of making clinker. So you get an enormous reduction. If you can get to a 50-50 mixture of recycled glass, powder, and clinker, then you lower the carbon footprint by nearly 50%. But I mean, the challenge you have now is that Harvard University students and faculty and alumni are pretty skeptical people. And so the university can claim, oh my God, we have this big reduction. The question is, well, how do you know? Prove it. And that's when we have to use the E-liability method, because Harvard is not buying the glass powder. They're buying concrete that's being poured into new buildings, what's called embedded carbon. And so we have to be able to trace this product through its supply chain. It's a relatively short supply chain that goes to a concrete mixer, in this case, Boston Sand and Gravel. And they're the ones that are mixing this cement with the new powder into it, potentially. And also all the other aggregates and water and things. And so we have to get its carbon footprint, including all that. And then it has to come up to the contractor who actually is going to purchase and pour the cement. And so the case describes and has an Excel spreadsheet that's dynamic, and it says, well, what's the impact of using traditional Portland cement? Let's suppose you use a mixture, say with just slag and the cement, and what about the mixture of this glass powder and regular Portland cement? And so the students with a dynamic Excel spreadsheet are able to calculate the different carbon footprints associated with this purchasing decision. And well, how do we know it's still true? Is we worked with large technology company, in this case IBM, and they already had a blockchain solution which enables food retailers like Walmart or Target to actually trace the quality and safety data of farm products, starting from the farm of the plantation all the way up its supply chain. And so the food retailers, within a few seconds can get quality and safety data about any product that's on its shelf. And it's the same tracing using blockchain, and it's private. So, Walmart only sees the data from its suppliers. And it doesn't even know the name of some of those suppliers because they're so far upstream, and that's confidential information. But they are seeing that with the assurance documents. And so, they were starting to mock up, the technology that would enable Harvard University or Oxford or Stanford, other collaborators, to be able to measure and validate the emissions that were produced for the buildings that they're building up all around their campuses. So that also, as you say, got us into thinking about cement and in an article that Karthik and I and Stefan Reichelstein of Stanford published in Harvard Business Review digital edition in February of this year. We documented Heidelberg materials and using, these different mixtures. They're just using slag and clinker. And you could see that as you went to a 50-50 or 65-35 mixture of slag, that the carbon content went down dramatically. The only performance differential is that the mixture with a lot of slag in it takes longer to dry and harden. But afterwards it has the same properties. So it may not be good right now for building vertical buildings because you have to wait for 25 days to get all its structural performance, but it's certainly good for slabs, putting things down on the ground where, you don't need all that structural integrity right away. And so they now have a basis of talking with their customers, and particularly government customers that are in large construction projects, and offering that opportunity of taking, again, what had been a commodity product, cement, and saying, well, which version of the cement do you want? Which carbon content, and talk about that. So that was pretty good. And the other pilot that was described in this February 2023 Harvard Business Review article was a tire company in Indonesia that Karthik mentioned earlier. And so they were a little bit downstream from a steel company. Turns out that steel was one of their 4 primary suppliers that they go into the radial tires, but they had 3 other very, large suppliers in a tire, suppliers of carbon black, synthetic polymers, and natural rubber. And as we guided them through that project, they went to each of the four suppliers and asked them, what's your carbon output per unit of output product that you supply to us? And they got that data and they put it in the Excel spreadsheet. And then they got their own scope one emissions from energy they were producing, scope two that they were purchasing. And they could build up the carbon content for a standard passenger tire. And that's a calculation that they could do in the spreadsheet. But, three of the suppliers says, why did you ask us this? And they says, well, we want to get a report that we can send to our customers, the OEM automobile companies. And so we started this process. Well, they said, well, no one ever asked us that before, but we actually have some processes that could produce the same essential product with lower carbon emissions, just like the cement company. And are you interested? And they said, well, sure. And so they asked them to go back and estimate what the revised carbon output would be, the emissions, using these new greener processes. And, the savings range from 25 to 40%. The tire company looked internally as to how they could get lower carbon energy, solar panels, substituting natural gas for coal-fired electricity. And they got reductions in their own scope one and scope two emissions. And when you recalculated the spreadsheet, it turns out there was about a 25% reduction in the carbon content associated with that tire. And they could go to their customers, BMW or Volvo, and now just like the cement company going to its customers, they could say, are you interested in this? And talk about the, what the functionality was, could they scale this up, and also perhaps a little discussion on price. So, we were really gratified by taking what, as Karthik said, seems like commodity products, whether it's steel or it's cement or passenger tires. And there's a lot of variation, a lot of heterogeneity that can get introduced, or in the strategy literature, differentiation. You can differentiate your products not just by quality and price and delivery, but now by dramatically lower carbon content. And this is really what's going to set the decarbonization going. And Karthik, maybe you can describe one of these other commodities like copper and what we've learned about copper.
Absolutely. Let me just pick up on two themes in what you said, Bob. The first is as we think about the GT tire case, that sort of really illustrates the power of, Piyush mentioned the 80-20 principle. Bob, in his earlier work, has talked about the Willie Sutton rule. Not trying to boil the ocean when you're running a pilot. And if this is your first instance at doing this, in the case of the tire company, they had 196 suppliers. And they said, well, but 4 of them really account for the vast majority of emissions by weight of the tire, at least. So that's a rough approximation for where we might start looking for things. If you're interested in more about the tire company, then there's a case study from Oxford University that is available. It's called the GT Tire case, and you can get that from the E-liability Institute website for free. It's e-liability.institute. In the terms of the Heidelberg cement case study, one of the things that came out of that project, and this is joint work with Stefan Reichelstein and Bob, is that they've started deploying this method in a dynamic setting, which is to say that they're able to get batch level differentiation in different cement types based on, of course, the different inputs and processes used. And interestingly, just outside my window here is one of the largest construction sites in Oxford University, and they're using Heidelberg cement there. So when Heidelberg starts selling cement here, in this case to Oxford University, they're able to identify the level of individual batches. What is the emissions profile of each type of cement that's being used? And of course, certain customers, in this case Oxford, but also, as Bob mentioned, emissions-conscious governments would treat that information as really important in making purchasing decisions. And if you're interested in that case, then Stefan and his research team have written a fabulous case, which is available in the Stanford case system. And so we'll direct you to the Heidelberg case on that. But Bob mentioned that we've also run a pilot and we're in the process of actually wrapping that up. This is still not available publicly, so we won't mention the company just yet. But this is one of the world's largest manufacturers of electric transformers. And when they read the e-liability paper, they were interested in running a pilot with us. So they came to us and they said, we'd like to do this. And we said, well, why don't you help us identify what is the problem that this pilot will solve for you? And where it is they started was the recognition that they were under enormous pressure from certain stakeholders to use recycled materials in their supply chain rather than virgin materials. And in this case, the core raw material used in electric transformers is copper, which is used in the coils. And so copper is, of course, very emissions intensive to mine and refine. So the idea was they can use recycled rather than virgin copper. But their own engineers were not convinced that this is necessarily a greener thing to do. So we worked with their supply chain to try put some numbers on this. We have no horse in the race, so we said what we can do is actually measure things accurately. So we worked with this company's supplier, its supplier's supplier, its supplier's supplier's supplier, all the way down to the copper mine itself. And the answer is it depends. There are certain copper mines in the world that are so efficient in the sense of they use low emissions explosives, they've electrified the transportation in the mining process, that they're able to actually produce copper at a substantial saving relative to the recycled copper. And when I say substantial, I mean over 50% savings. But of course, there are also mines in the world where, they still use standard practices. And those mines, it would maybe a break even with using recycled copper. One of the reasons why recycled copper isn't as green as we would imagine is because the copper is usually recycled from circuit boards. And those circuit boards are, of course, using plastics, which are not low emissions plastics. So when those plastics are incinerated to harvest the copper, they generate enormous amounts of CO2 released into the atmosphere, which must be accounted for. So the process of this kind of full emissions accounting allows us again to bring new facts to the debate and new information into thinking about what might constitute actually a green transformer versus, say, a transformer that is less green. And this connects back to the point that Bob made earlier, that one of the advantages of the e-liability approach is that we don't need to look at discrete labels like green versus non-green. We want to actually count things as a continuous variable. We want to say, what is the emissions associated with this process? What is the emissions associated with this other process? And therefore, what are the emissions that we allocate to these eventual products? And then customers can make an informed decision about what is the product that they want to buy, just as they do with, say, cost information. So that gives you a hint or a flavor for some of the various case studies that are underway. We also have case studies with not-for-profits. We're actually running a case study here with Oxford University Hospitals, thinking about the e-liability of hip replacements. Hip replacements are at once fairly complex surgeries, but they're also fairly routine surgeries. So one of the reasons we chose hip replacements as a place to start with a healthcare pilot is because it would allow the organization to both reflect the complexity of its operations, but also use an operation that is fairly routinized, therefore generalizable across the various things that a hospital does. So in a nutshell, if you or an organization you're familiar with is keen on employing the e-liability principle to learn more about decarbonization, then we encourage you to contact us at e-liability.institute. We now have a full-time team that can help with pilot implementation, and we'd be very keen to work with organizations, not least because, as Bob mentioned earlier, regulators are looking for examples of how this might actually work in practice before they start rolling this out system-wide. Now, one question that comes up in a lot of our pilots, this certainly came up in the electric transformer pilot that I just mentioned, is after a company runs this approach in the first instance, and they might learn something and they like it so much, they come back to Bob and me and say, okay, great, now how do we scale this? And this is a challenge for us because we're two professors, we have full-time jobs at universities, and we actually have no product to sell. We do all this effectively as a public good. And of course, if organizations want to scale this, Piyush mentioned earlier the importance of having software systems that would allow this actually to work across entire supply chains, then we do need those kinds of intermediation products. And the good news is that at the E-liability conference that we concluded in June, this in London this summer, we heard from an emerging number of intermediaries in this space. Notably, SAP has a product which is called Green Token, which might be able to do some of what we are hoping an e-liability software system would do. SAP, as you know, runs S4HANA, which is one of the largest ERP systems in the world. So it would be great if they're able to build a plugin that also works for robust carbon accounting. But of course, SAP is not the only player in this space. Bob mentioned earlier, IBM is looking with blockchain products in this space. We've also heard from other organizations that are building technology, either blockchain solutions or token solutions in this space. And we're also looking at assurance providers, both from the traditional audit field, but also non-audit assurers, like technology companies that have great satellite technology that want to get into the carbon assurance space. And they would also want to contribute to the development of this ecosystem. And the E-liability Institute, as a neutral third-party entity that really sees itself as a not-for-profit catalyst for this movement, is very keen to encourage this kind of innovation. The thing that Bob and I always say when we talk to regulators and standard setters, and indeed organizations that are piloting the e-liability approach, is that if we're successful, then the E-liability Institute won't need to exist in 3 to 5 years, because this will just become second nature to the way organizations think about carbon accounting, just like you don't need a cost accounting institute to get organizations to use proper cost accounting. That information, that role is now taken over by many other organizations in the economy.
Yeah. So
So that
one
gives you,
thing.
sorry,
Yeah,
go ahead, Bob.
no, we want to commoditize carbon accounting. We don't need a brand for this. It's just straightforward measurement and accounting, and everybody should use it. That would be great.
Exactly. So that gives you hopefully a quick tour of where we are from the last time we met, which was at the CARE conference last year. And we hope that the developments here will inspire you to engage in this as well. For those of you who are academics, there's a lot of research to be done in this space, and we would encourage you to engage in those research projects. We are happy to support you in any which way we can. So please, again, reach out to us either directly or via the Institute. And for those of you who are innovative company leaders like Piyush, please join in the pilot movement, and we'd be keen to work with you to find ways in which we can deploy this method to solve problems in your value chain.
So maybe, Karthik, just to wrap up, give you kind of what I feel our takeaways are from this 12 months of experiment is, first is we're really grateful to companies like Tata Steel and Heidelberg and GT Tires and others that we will soon name but cannot name, because it's going to break us out of this impasse that we faced. I mentioned we talked to the regulators and they say it's a good idea, but we can't use this method or require it if you haven't field tested it. Companies haven't used it. And many companies that we talk to, we don't have a 100% success rate from initial conversation to pilot project. They say, well, we're already a leader in the current regulation in the Scope 3 measurement. We do this as well or better than anybody in our industry. Why should we invest additional resources to get beyond what's required today? And so that limits the number of companies. And how do you break this impasse between companies just meeting the existing regulation and the regulators not wanting to be more precise in what they require? And so we're really grateful to the leadership and innovation of this, in this case, more than a half dozen companies that stepped forward and said, no, we're willing to be pioneers. This is important to us. It's important to our shareholders. It's important to our customers. And we're willing to be the pioneers. And then within those companies to identify people like Piyush, who turn out to be great project leaders. They feel passionately about decarbonization, and they want to invest the time and energy in their careers to make this happen. So, we're very fortunate to have both the pioneer companies and great project leaders. Second, to reiterate something that Karthik summarized earlier, commodities aren't commodities anymore. You can look at products like steel, tires, cement, copper, and now they can be differentiated. They can be differentiated through lower carbon emitting processes by themselves or their suppliers. So that's incredibly exciting, but it's only differentiated if you can measure it in a credible, verifiable way. And that's what the E-liability method has done this. Third, at the conference that Karthik talked about in London, people said, well, the way we have to do this is we have to standardize the methodology. Let's standardize this so then we can roll it out across the world. And kind of my feeling is that standardization and innovation are mortal enemies. We're only a little over 18 months into this journey, and we're still learning a lot from the pioneer companies about the method and also how to apply the method in a robust and scalable way. And so I think there's been some errors in this space of people standardizing too early, and they standardize without adequate field testing and verification, and you don't get to where the destination should be. So we're going to continue to innovate. And again, that's part of the E-liability Institute, is to continue to learn from doing this work in all different types of settings and industries and production processes. And then finally is just to again repeat what Karthik said, we have to get away from simplistic labels in this field. People think, that the world is binary. The world is not binary; it's analog. And processes are not green or brown. Or green processes are not always better than brown processes. We have to be judging by continuous variables, which is which one is reducing the supply of carbon molecules going into the atmosphere. And the same story about virgin versus recycled. Mandating recycled materials is going to get you in trouble in steel production, as we heard, and in copper production. And the issue is not whether it's virgin or recycled, it's which process for this product and this sourcing is producing fewer carbon molecules going into the atmosphere. And this is really the triumph of accounting. We should feel great about this because accounting is giving us this ability to measure on a continuous scale, how many emissions are being produced in this product or this service.
Thank you. And thank you, Bob. And thank you, Piyush. And I think the triumph of accounting is a wonderful way to end this presentation.